Well, good afternoon, everybody. Welcome to the December 7th edition of Bull Sessions. My name is Mark Robertson. I'm joined here by Ken Cavola. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, everybody. It's kind of a dreary day here in mid-Michigan, but it's really cold. We got cold. Did you get into the low teens last night, Mark?
Pretty chilly. I mean, we did some we actually left our keyboards to do some real old-fashioned shopping. And man, that wind was whipping last night. And then we also played tennis last night. So yeah, we were out in it and hearing reports from around the country. We're getting all kinds of extremely unique weather. I was told that Denver still does not have snow. That made a change today. But this is the latest that Denver has not had its first snowfall ever. So some weird stuff going on. But we keep pressing on. Well, speaking of nasty weather, that's part of what today's theme is about.
Yeah, let's push forward here and see what we have today.
Well, you know, that nasty weather theme, and, you know, if you don't have a rhino to guide your sleigh in your Santa Claus, you definitely need that beacon from Rudolph, and that's kind of what we're going to talk about a little bit. The market, which has been a little bit of a, you could say, nasty weather in the market for the last year or so, depending on where you're positioned and what, but there's hope. There's always hope. All right. Here's our standard recommendation. I see that most of you are very familiar names. We do try to keep this informal. Ken will monitor the questions tab. If you want to raise your hand, we keep things informal, and we will do that. But everything that you see or hear talked about here is about education, illustration, and demonstration. We are here basically attempting to implement the lessons, philosophies, methods, and techniques of the modern investment club movement as championed by the National Association of Investors, now known as Better Investing or Manifest Investing. Everything that you hear will be an opinion. And please, you must do your own homework when you're doing your Christmas shopping for equities. Please make your own decisions. If we own something in our portfolios, and Ken and I both own Microsoft, we'll be talking about Microsoft in a few minutes, and it is the #1 holding in our roundtable tracking portfolio also. For the monthly webcast known as the Roundtable, which we've actually held last Tuesday, had a good time. 5 exceptional companies, all trading near their 52-week lows. If you want to check out that session, I have great hope for all 5 of those selections. But if you'd like to be added to a reminder list about that monthly webcast, send an email to ncavula1@comcast.net, and Natalie will make sure that you are kept apprised of any opportunities for future sessions. If you have any questions or suggestions from today's session, you can write to either Ken or myself at the emails at the bottom of the screen. Mark R. at manifestinvesting.com or kcavula1@comcast.net. Anything else you'd like to add, Ken?
No, sounds really good. I do have a hand in the air, Mark. I'm going to unmute Herb. Herb, yourself. There we go, Herb. Go on.
Yeah, I just wondered if anybody has done anything with HGTY, which is a brand new company out of Traverse City. Haggerty Insurance just became a public company on Friday.
I'm familiar with it by name, but I didn't realize they'd gone public.
Are you guys up there trying to pump this stock, Herb? I got notes from 2 of the folks in your investment club, and now you're the 3rd one. You pump it. Did you all buy some, and now you want the stock price to go up? Is that it?
Of course we did.
Of course you did. Okay.
Isn't this the premium insurance company on the fancy cars?
For antique cars, yes.
Okay.
They've become an insurance company, but they're also worldwide now with offices in England, and they're hoping to get into Europe. But they were a space company first, and then they just became public on Friday. They rung the bell at the New York Stock Exchange on Monday morning to open it. And they're now becoming an experience company where they want people to start driving their antique cars because the younger generations don't understand the value and how much excitement there is in driving with some of the older cars. So just wondered if you'd done some checking on it. And, like I say, there's not a lot of data on it, but it's up to almost $16 a share today.
Well, we definitely will take a look. And Herb, you get the absolutely wonderful grifting award for the day. That was, to those people in the audience that might be wondering, that was not planned, and it was absolute raw, unrehearsed grifting.
And this is not a recommendation. You should do your own judgments on that, decide whether or not you want to get into it. But I am a buyer of it, yes.
I will tell you that the company has a heritage of success, and it's probably got a pretty good-looking red herring and prospectus and all that kind of stuff. So it's probably a very interesting look. All right, so here's some of the themes that we are going to cover today. Ken, go ahead.
I just said thanks to Herb, and Len puts through Len always does immediate research for us, and he says HGTY has warrants. So I'm not quite sure where that's heading, but I guess he just wants you to all be aware of that. So.
Yeah, and we've talked a little bit about Joel Greenblatt in his book. He talks about warrants pretty extensively in the spin-off type aspect. Basically using those type of things in the spin-off theme. So could be there. All right, we're going to cover 3 main topics, and along with a few others sprinkled in here this afternoon. I'm going to spend a few moments with our market barometer, favorite indicators, that type of stuff. Do want to dust off this Barron's small cap feature. I believe they refer to it as sizing up small caps, and just take a quick look at that. Then we'll spend one of our S-curve moments with Microsoft, and that one turned out to be a lot more fun than I expected. So I actually did dabble a little bit with my inflation reading list, Ken. So I have made a little bit of progress, so we should be able to do that here pretty soon. But I'm not promising anything. I mean, I went to sleep 3 times while I was reading it. So
I will tell you, Mark, that magazine that I talked about last week, that recent issue of Bloomberg Business with the word inflation on the cover,
okay,
has some really interesting articles from different points of view. This is not the usual stuff in a lot of the writing in that particular issue, and if you can get a hold of it, there's 3 or 4 in there that you might find will be the basis for a really nice discussion.
It's on my list of things to track down, but I had not done it yet. But I will move it up. I'll move it up. I will move it up, and then we will be covering other topics in coming weeks, as you see at the bottom of the chart. All right, here's kind of our theme for the day. I thought this was a worthy theme. That's actually from the Motley Fool. I don't remember how long ago, but it's a pretty timeless theme. Buy good companies at good prices. That sounds pretty familiar, huh? Be patient, and then go enjoy. Not bad advice. All right, here's our groundhog moment. Thought we'd go at it in reverse this month. I thought that, again, the nastiness just amazes me with Kathy Wood. Listen, I guess that's what happens when your mutual fund or exchange traded fund goes up like 200% in one year and then doesn't the next year, because there's an awful lot of performance chasing out there. But these guys were particularly cruel. After the Detroit Lions won their first game of the year, check out that opening line of the article. Unlike the Detroit Lions, she's still looking for her first win. And again, this is just a reminder that humility comes in cycles too when it comes to stock picking. I mean, I can actually go back and point to, and Ken has seen me do this. If you go back and look at some of the roundtable selection periods, and Ken will actually probably admit that he's had droughts in periods where things were a little bit tough. I mean, I know you guys,
absolutely, Mark.
All of your groupies don't tend to remember this, Ken, but we all have these bouts with humility, just destroying moments. But and that's what you're seeing here. I mean, I don't think there's anything wrong with her overall strategy, but it's going to have up years and down years. End of discussion. I mean, that's just the way it is. So she's kind of fallen behind. And I didn't think it was possible for her lead on this manifest to shrink as rapidly as it has, but it has. She is now just, a couple of fingernails ahead of the number 2, and that's a very specialty Fidelity Select semiconductors, and they've been hot. So they want, they're not going to stay there forever, but they've been hot. And Barron Partners Retail is actually, they've been near the top of this list for a very long time. Barron Partners, it's a traditional mutual fund. If you see an M on here, just to be clear, M stands for mutual fund. So traditional mutual fund here. And any traditional mutual fund is going to have a ticker with 5 letters in it. And if it doesn't have an M, that means it's an exchange traded fund, as Kathy's fund is, as is VGT. And I actually think it's a pretty good time to be loaded up on VGT or some of those type of companies. We're going to talk about why. QQQ, Total Stock Market, VTI, basically base loaded on those and then pursuing our other stuff, very much like we do with the Bare Naked Million portfolio. That strategy seems to be working out pretty well. But the point of this slide is her lead is down to basically nothing. And
I think it's important, Mark, when we flash this chart up there to draw people's attention to the top of the chart and the headings on the various columns. I heard somebody that attends bull sessions on a pretty regular basis a couple days ago indicating that they heard from the bull sessions that the best mutual funds only made 8 or 10%. That's not a total return column that Mark has in the last column, folks. That's a relative return column, and that means that's how much they beat the benchmark. The total return is 2 columns to the left of that relative return, and you can see those numbers are significantly better than 8 or 10%. So when you're quoting numbers, it's really important to understand what those numbers are saying. And that relative returns means that they're beating their benchmark by that much. Not that they're returning that much, but they're beating the benchmark by that much.
Yeah, and you are looking at all 20 that are above, well, almost above 6% relative return. That's 20 out of approximately 800 funds that are on our working list right now. So this is pretty rare air to be up this high. And then there's probably only another, I want to say approximately 30 that are above 5. So it drops off pretty rapidly, and then they go red. And when they go red, they're going to be down closer to 10, 12% and decline from there. So these are the achieving funds. We tend to think of these funds as a source of ideas for individual stocks to study also. But thanks for the clarification, Ken. That is important. One thing I would point out, that for those people who believe in what she is doing, this relative strength index suggests that it could be way oversold. There's a lot of people jumping out. The redemptions are probably an issue for her. But I would point out that the growth is strong. I think these numbers will go up as soon as we get through some of our audits. But again, it's not core investing. Does that cover it pretty well, Ken? To just basically point out that it's not core.
I think absolutely, it's non-core to the hilt, and she's not following what we indicate. You know, we're suggesting that in a typical portfolio for an experienced person, you might have as much as 20-22% in non-core. She's looking at a portfolio that's probably in excess of 75 or 80% non-core, maybe even more than that.
Mm-hmm.
So it's a different style of investing than we typically suggest that you use if you want to sleep at night. And I would imagine that Kathy's had a few sleepless nights in the last couple months.
Could be, but she's not admitting that. And I think I understand. I think I understand that. I think she really believes.
Yep.
And you know, she has a very large position in Tesla also. Here's the groundhog standings. Again, we thought we were only going to do this for a few weeks, but I think at least it gives you guys an update as to the official scoreboard. we're still lagging pretty badly. Only 20% of us are beating the market. That's by far the lowest number in a long time. Kathy does check in at 140th out of 144, so that's how cold she is. But a lot of familiar names, a lot of wonderful names on this list. And Ken, the group entry actually, we've been passed up by those renegades from Florida.
I noticed Space Coast has moved up ahead of Mid-Michigan Model. Okay, well, there's time yet. What do we have yet? About 2 months now.
You've got 2 months to go. You know, and I have had offers of oysters and various drinks and, you know, stuff from the people down there. So the scorekeeper, they have attempted to compromise the scorekeeper. No, I'm making that up. But they should. They should try to compromise the scorekeeper because it would probably work. Anyhow, the one thing I do find interesting is I've had a kind of a slow year as an individual, but by golly, Ken, our roundtable entry from last February is doing pretty well. And of course, Nick D up at the top, tipping our hat in the general direction of New York for Nick D. All right, good stuff. All right, just a quick update on our best small companies. This is a little bit of a Christmas present. As you know, we were trailing both the traditional, which is the buy and hold, buy and forget version of it from Halloween to Halloween, versus the active, which is we will actually do some selling and switching transactions, and versus the market. So we're ahead. So cyber applause there. We know enough not to get too excited about that because this thing was moving around by hundreds of dollars in the final days of October this year. But we'll take it. We'll take it that the things have strengthened. The only difference between traditional and active at this point is that, at least so far, a traditional replacement of eHealth with Pachira Biosciences. So if we had just simply held on to eHealth as we do in the traditional portfolio, we're here. But the replacement, switching it out with Pachira, has brought us to here. We hope to see that continue in an impressive way throughout the course of the year, because we're just basically implementing our disciplinary when to sell measures on the portfolio.
And just in case you're new to looking at our graphs, those two bars, the red bar and the blue bar, the tops of those are less than $10 apart. So right now there's not any significant difference between the two portfolios. There hasn't been enough time for there to give a significant difference yet.
Yeah, we're just 1 month in a few days.
Yep.
But yeah, Green Brick Partners, off the charts to the upside. Boston Beer had a nice day or two, and a couple of them slipped down, but they were offset by the gains in those companies. Green Brick was up almost 20% from where it had been. Good stuff. So we'll be checking in, keeping track, and obviously keeping the audience advised and doing functional audits as we go through the year. So let's talk about barometers and Rudolph's nose. Do you still watch those type of shows, Ken?
You know, I don't have any grandkids that we used to see 2, 3, 4, 5, 6-year-olds 4 or 5 days a week. We now only have one really young grandchild, and we only see her maybe once every 5 or 6 days. So we don't have a reason to watch these shows nearly as much as we used to. I'm afraid that Natalie and I find ourselves sitting, looking at each other and reading in the evening, not even watching TV a lot of times.
Well,
so
I'll see if I can get Maria to put on the nose, and you'd watch her.
Okay.
Bart Aroma, for those of you that are wondering who in the world Maria is. Let's talk. This is our kind of one of our favorite benchmarks we tend to go to virtually every month, if not almost every week. And it's just pointing out, it's taking the companies that are in the Value Line Standard Edition, again, approximately 1,600 companies. The average price, basically as an index for the companies in that book, is represented by the green bars. And you can see we've had a pretty strong year following that really nasty moment in March of 2020, when the return forecasts actually shot up and went kind of crazy. Comparable to what happened back in 2008, 2009 in terms of the size of the disruption. It was much quicker, not quite as deep and much quicker, but we're kind of back in that fairly valued range of 8 to 12%, which is kind of what we're seeing. Is that kind of what you're seeing with your stock studies, Ken?
Yeah, I'm. It's easier to find stocks that I might want to purchase, but there's nothing dramatically affordable right at the moment. They're much more affordable than they were, say, 3 months ago. But still, you can always find a good stock. It's just not, you're not going to, I'm not finding home runs at the moment, at least. Mark, we have a pretty good question. If you could go back 2 slides, I'm sorry. We have 2 different people wanting to know, why is the benchmark number negative? And that's an easy one to answer, but I don't think people are used to seeing that kind of thing happen. So why don't you go explain where that benchmark number comes from, Mark?
Well, isn't it wonderful that it's weird? I mean,
Yep.
What you're basically looking at is that's telling you that the market has actually decreased. We measure the market by the Vanguard Total Stock Market Index. For our purposes here, we actually use the ETF, which is VTI. That's Vanguard Total Index, VTI. And the value of VTI is actually less than it was on Halloween. So it's gone down a little bit. You can see that on the date that we purchased Pacira Biosciences, it was actually 3.6% behind. You can actually see that shown here, or at least we're down 3.6% from that day, from the 16th of November. So the markets have been moving around kind of crazy. So, and so it's just a reference to the fact that the market's down since Halloween.
Yeah, so we're taking, for those of you that asked the question, we're taking the difference between the total return number and the benchmark number, and which that means to find the difference between them, you're subtracting, but you're subtracting a negative. And you go way back to your 8th or 9th grade algebra class, and most of you remember that if you're subtracting a negative, you're really adding it. So that's where the 18.8% actually comes from. 17.5% to the good, and then you had to make up 1.2% before you started into positive territory. So in all, there's a difference of 18.8 points between the negative 1.2 and the positive 17.5.
Yeah, it's been a while since we've had those type of numbers on a chart, so it's a worthy observation.
Yep. I hope that answers the question for those of you that asked it in the questions box there. Thank you.
All right. Very similar data, except that this includes dividends, and it's the entire manifest investing database. It's a major difference between the previous slide and this one. And this is the median projected annual return on the stocks that we follow. Again, it's going to be very comparable, very similar. In the background, in the light green, is the Wilshire 5000, whereas this one back here is just looking at that value line population of 1,600 or 1,700 companies. This one is actually looking at the Wilshire 5000. And again, it's fairly traditionally average to be in that 8, 9, 10% zone when it comes to the median projected annual return. So again, it's just basically pointing out that the market is basically fairly valued right now, or fairly close to it, according to this metric. Okay, and of course you can see the excursions back in 2008, and you can see that excursion from early 2020, which was sudden and pretty abrupt. All right, next indicator, it hasn't been around for a while. I don't know if anybody else is experiencing this, but the last 5 or 6 times I've gone and tried to pull it up, it's been out of service. We do track the Morningstar price to fair value ratio for all the companies in the manifest database, and that currently checks in at about 97%. Again, 100% would be fairly valued. They're suggesting that the market is slightly undervalued, so a little more on sale, at least according to the numbers that we look at. And Ken, as I was telling you, as I was crunching through the updates here recently, there was a lot of volatility in those numbers. A lot of jumps up and jumps down and kind of all over the place. And because that is an influence on how we look at PE ratios, fair value based PE ratios at manifest, it was enough to cause a bit of a disturbance and definitely some head scratching. And at least one morning session where you and I talked and I was gnashing my teeth a bit. So it has been a little bit erratic, and I'm not so sure, maybe they're having a little bit of a organizational debate over there in Chicago. So we'll just leave it at that.
Well, it's so much of it has to do with the fact that I think that the analyst community, let's give them credit for doing a pretty decent job most of the time. But I think the analyst community, many times when you see things you've never seen before, are just as confused as some of our own experienced investors in our own community are. I mean, come on, how many of us had seen what happened in the last year and a half ever before in our investing career? We'd seen market crashes, but nothing that even came close to what happened when it crashed and then recovered. And we were able to sort stocks into a couple of different piles, and one of those piles was the crash never happened for those stocks. In fact, we're going to look at one of those stocks where you can't even see the crash when you graph sales or pre-tax profit or earnings or anything. You can't see the crash at all from 2019.
Yeah, in all fairness to the Morningstar people, I mean, the chasm, as we described it, and go back and listen to our session, I will tell you, and I think Ken will also admit, we weren't 100% warm and fuzzy with some of the stuff that we even presented at that time. I mean, this was a really sudden and ugly and fairly unprecedented, I almost hesitate to use that word, for most of us as investors. So yeah, this extends well beyond Morningstar, but that chasm and what it does to what they do with their optimism and their pessimism is just, I'll just say significant. And that's kind of what I was seeing there. All right, one other slide that we don't present very often, but I do like to, in terms of kind of the really macro or global perspective it gives me on investing in general. We've covered this with some of Barry Ritholtz's stuff in the forum. What it basically amounts to is it's a graph. In the background is the S&P 500, but the actual bumpy green and maroon areas that you see on here represent the difference between new highs in the stock market versus new lows. So it dips down when there are more new lows than new highs. And you can see that period back in 2008, 2009 was a pretty nasty period where there's just a whole lot of new lows being set. And the thing that we pay a lot of attention to is this 12-month moving average of these ups and downs, just to give it a little bit more statistical smoothing. And again, anytime you start to dip below zero, as we did back in here, and then continue deeper, it can be an issue. Otherwise, it could be just a bounce. But we had one of those moments back in 2015, and it did bounce back, and we've had others. We're in another one now. And some really kind of weird stuff going on with some of those companies, the more obscure companies, just getting really damaged. And again, just kind of thinking out loud and scratching my head out loud, one of the things that I think I pick on, at least intuitively, not sure I can prove it yet with the numbers, not sure that I could ever prove it with the numbers. Anytime we go through one of these moments, to me, it's almost a suggestion to really, as soon as you feel it, the moment passing, just any notion that we will come out of a recession or whatever, it is time to go after these smaller companies. You can actually see on this chart the performance of the years for our best small companies list, and some of the better years on this chart are following some of the nasty dips up at the top. So I feel like in terms of where we are at in today's market, probably in one of those moments where you want to make sure you've got good defensive, good solid core holdings, but be ready and willing to go into some of the better small companies, the excellent small companies when the opportunities present themselves. So am I throwing tea leaves on the ground, Ken, and reading what I want to see here, or does that make any sense at all?
Well, you know that my druthers are to look at small companies and to buy them when I think they're a fair buy, and to demand out of those small companies the same kind of consistency that I look for in my large companies. I'm not a very good early stage investor. I'll admit that to anybody that wants to talk about it. I'm a terrible speculator, and I don't have the stomach for early stage investing. I just hate to lose money. So I'm always looking for these companies that have a little bit more of a track record. I think also, Mark, that we're looking at times when there's been a lot of new companies flooding the market, and they haven't all necessarily been based on any kind of valuation other than that price to hope that was on our graph that we were, on the graph, on the chart that we've been looking at off and on for the last 4 or 5 weeks. An awful lot of people bidding things up to prices that I just regard as foolhardy. So I'm not sure that I see the same thing you see on this graph. I understand why we have all these low prices coming in at the moment, but I happen to think it's maybe some people coming to their senses and deciding to bail on companies that they maybe shouldn't have bought in the first place.
Yeah,
that's enough said on that. Yeah,
possibly some January effect too, but let's come at it from this way. The market's up 20 to 25% over the last year, depending on when you check and how crazy the rhinos are getting on a given day. Ben Carlson shared this recently, and it's actually in our This Week update. In a year when the market's gone up 20 to 25%, there's still a huge number of stocks out there that have a pretty extreme downside. And the thing I like to point out, here's that VTI. This is the Vanguard Total Stock Market ETF. That is down. It's market weighted, market cap weighted. So it is dominated by those companies up at the top of the chart, the Microsofts, Apples, Facebook, whatever they're calling themselves today, and a few others like that. Those companies continue to, out of those 5,000 companies that are in the data in the index, those top 20, I'm not sure what the number is, but it's somewhere between 60 and 80% of the market cap is confined in those literally top dozen to 20 stocks. So as money pours into this, and by the way, the amount of money in the total stock market index, whether it's the mutual fund or this index, is now up to $1.3 trillion. So, with 401ks, et cetera, and people investing in general, you basically have a lot of money pouring into the equities of these dominant companies. And so the ones that are not in that top 20, there's got to be some in that 4,980 that aren't in the top 20 that probably deserve a little more inflow of interest. Does that make any sense, Ken?
I think it does, Mark. I'm asking myself the question whether we're also seeing the increase in the number of people that have chosen to become just plain passive investors. Remember that if you're passively investing in indexes that represent the whole market, then you're buying these top 20 stocks on a regular basis, and you're contributing to the fact that maybe they're not particularly the kind of stocks that are something that are a buy all the time, even though you might be on a regular basis, putting money into them. That's kind of a backdoor way of saying I still think that I'd rather choose individual stocks than look at an index.
Yeah, in a really weird way, and this is going to set a few people on their ears, maybe even you can. When you think of investing in defensive stocks, I mean, I've always tend to think of core stocks, but there's a traditional realm of defensive stocks. But I think the defensive stock of today is those 12 to 20 stocks in this type of an index.
It doesn't set me on my ear at all, Mark. In fact, I've said that in a couple of investment club meetings in the last 3 or 4 months, that it's important for us to have a presence in some of these stocks. Not all of them. You don't want to build a portfolio focused on those, but it's important to have a presence in those stocks. If you don't have one of the top 10 biggest holdings as one of your core holdings, then I think you're going to have a hard time keeping up with the market.
Absolutely. So we're in agreement on that. I tend to think that it's kind of in the mode of self-fulfilling prophecy, or if you want to think of it as almost artificial price support. And why not take advantage of that? Oh, well. All right, let's talk a little bit about the small caps. We're always looking for sources of ideas. This is one that I want us to watch a little bit closely and see what kind of erupts out of it. Barron's has kind of reinvigorated their sizing up small cap feature, and one of the lead writers for this is Carlton English. I've actually run into her on at least one occasion, but she seems to cover some pretty good stuff, so I followed her on Twitter, and we'll see what she does. She had an article this week on this particular company, and she makes the case, a very similar case to what we have talked about in terms of residential construction. Do you have any familiarity with this UMH Properties at all, Ken?
Absolutely none, Mark. And I thought I had a fairly decent handle on the top stocks in the residential housing industry. I'll admit I only follow 1 or 2 of these companies that really basically build, what are we calling them now? Manufactured home communities. But the UMH is a new name for me.
Yeah, it is for me too, and we'll take a look at the chart here in a second. I mean, I think there's a lot of solid thinking here. I mean, these type of homes aren't for anybody, aren't for everybody, I should say. But I will say our son lives in one of these, and it's basically pretty close to 2,000 square feet, and it's nice. And the rent, he's got a few roommates, and the rent checks in at, just like they say here, $800, maybe $900 a month. That's very affordable versus, I don't know if any of you have actually looked or have tried to help a friend or a family member find something to rent here lately. It's really a jungle out there, and those type of numbers can be found, and these things can be very, very nice. We saw that with Clayton Homes. Clayton Homes probably never got the credit that this community should have given it in terms of the quality of that product. So
and I also think, Mark, if you haven't walked into a new type of manufactured home, these are not single wide and double wide trailers anymore. These are homes that have a lot of finishing touches in them, and that they're a step up from what you might be picturing as a manufactured home community.
Mm-hmm.
They certainly have, they certainly have the ability to attract young folks and to attract people that are working in industries where the pay still isn't commensurate with the kind of effort that it put in. I have a granddaughter that works in healthcare right now and is having a devil of a time finding an apartment for her to rent. She's willing to pay a decent amount, but it's not the kind of rent that some of these apartment complexes want to charge her. I think it's a way to solve some of the issues with the huge increase in housing prices that is going on right now. So UMH, I'm certainly going to put it on my list. That looks like a really nice sales line there to start with.
Yeah, the top line is fine. The earnings before, that's actually the gross income line, or the earnings before interest, taxes, depreciation, and allowances. So it's before all the other stuff. So when you run this and you actually look at EPS, you're going to see a pretty big difference. One of the bigger differences I've seen in a long time. You must have a lot of accounting stuff going in there for a company this established. I think it's a little bit unusual. But again, 12% growth rate, obviously a small company, very consistent in improving margins. It's probably worth a little bit closer look. I don't think it's gone up quite a bit since being featured in Barron's here, and probably gone up 10% in the last couple of days. So the projected annual return does now check in at 6%, approximately 6%. Projected return on value right around 9%, so that could be a little bit stronger too. But notice that it's trading a little closer to the 52-week target price than we would like, and Morningstar thinks it might be a little bit frothy at this point. So again, just throwing it out there because of that top line and what it looks like and where this company may be going, along with the demographic influences that are in play there. Here's some of the companies that have been featured by this sizing up small cap feature over the last several months as they rev it back up. And we don't cover a few of these, so I'll be adding them to coverage. And you can see they have a pretty good track record. We'll put together our own list and track them all. But there's some pretty interesting companies on there. Walker and Dunlop is one that we have followed a little bit, as is true with Chart. And Brinker probably doesn't make our small list, but keep in mind it's another opportunity to distinguish between small cap and small company. Are you familiar with any of these, Ken? This well built, probably right up our alley, huh?
Brinker is the only one on the list that I know anything about, Mark, and I was surprised to see it on a list until I realized that Barron is focusing on small cap, not small companies. Mm-hmm. So I always liked lists like this, and I now have 9 more to add to my research and see where I'm going to go. I'm glad you're going to place them in the database.
We did. We did have.
I have a special place in my heart for water companies, so I'm going to start by looking at Aqua.
Okay, and this is Weight Watchers, WW International.
Oh, well, then I'm familiar with 2 of them then. Okay.
All right, I just want to report on some field research that my wife and I did in our Christmas shopping adventures. It didn't involve a keyboard. We actually went into Ollie's, and I'd never been in one before. I'd been suitably warned and conditioned going in, and I prepared her for the experience. It isn't that bad. It's just a little bit disheveled, and they do have some fun, but we actually walked out of there with several items, and I had to physically extract her from the children's books area since we have 3 grandsons. And I think she had an armful of books by the time I was able to get her away. But those books are like $2 or $3 or $4, guys, and really good stuff. And then I was remarking earlier with Ken that they had some really nice utility vacuum cleaners, Bissell and a few other name brands. And Ken and I were talking about, I shared that we ran into one of those NutriBullets. We actually have one of those in our kitchen, but we'd seen one just a few minutes before that. It was like $149 at Best Buy, and it was like $49 at Ollie's, just to give you some idea of the magnitude of what this overstock, and don't they do expired stuff that has actually moved on in terms of model years and that kind of stuff? And you actually...
Well, they certainly have a good time with. They don't take themselves very seriously at all, and you're right. If a store that's a little bit messy, the store is not dirty, but the store is messy, and if that bothers you, then don't go to Ollie's. But if you're interested in just wading through stuff and have no preconceived notion about what you might want to buy, it's certainly worth an hour or so on a Saturday afternoon. But then again, there's a lot of different things that you can do on a Saturday afternoon.
Well, just as another example, we bought a shaving and hair maintenance kit for our son. He has a beard, and so it had, like, 6 or 7 different kinds of clippers in it, and I know that same set goes for probably $75 ish. We bought it for $9, so he doesn't need to know that we only spent $9 for Christmas, but you know what I'm saying.
I know exactly what you're saying. I love
that sort of thing.
I love to give presents to my kids that look like I spent a lot more than I really did. So.
All right, so field research successful, and we probably will go back and do some more treasure hunting at some time in the future. All right, this week we're going to take a look at Microsoft in our traditional look at this theory, and just our reminder that this is more than theory. This is something that I think we should take even more advantage of as we analyze our companies and classify them and begin to build and imagine our expectations for these companies. Here's our reminder using Under Armour. Again, one of my favorite slides, showing that there's obviously 2 phases for Under Armour depicted on this slide, which leads us to this week's reminder, again, about what we're talking about. Paying an awful lot of attention to the top line and section 2A on your stock selection guides, and just being faithful to this whole process. And here's the company. And what strikes you, Ken? I'll let you just operate from in Picasso mode here.
Well, what strikes me, first of all, is the consistency from about 2016 into the future. And that's what I would expect to see happen. I would expect pre-tax profit margins, no matter how we define them, and this happens to be EBITDA, right?
Yes.
Rather than classic pre-tax profit, but it's close enough. And I would expect them to start to track with sales growth at some point if you truly have a growth company. I think the problem with Microsoft, and I've owned Microsoft since I've owned a couple shares of it since it first went public in, I don't know when that might have been, the early 70s, middle 70s, I'm not sure. But I have a lot more of it dating from the early and mid 90s. And I think that as you look at these graphs, you can see the fact that Microsoft had to reinvent itself a number of different times to stay relevant. I mean, how much money are they making from DOS today? I can't see a lot of it, and they've gone through product after product after product, and they've settled on a product mix right now for the last 4 or 5 years under their new leader that has given them a good, consistent profit. Maybe not as much profit as they were expecting in earlier iterations in the company, but this is what I would like to see in an established growth company, and the numbers are just there to show it. All that swaying back and forth with the pink line and those really fast growth, and then places of virtually no growth in the sales line. I think that's just the company going through reinvention after reinvention. And if the leadership is there, and luckily for this company, it has been there, especially when needed, if the leadership is there, then they can pull you out of a swamp and push you towards something even better. And that's what's been happening to the company, in my estimation, at least.
Yeah, I mean, I look at it and I see 3 obvious phases. I put the blue highlighting there to basically break it into 3 parts. And I tend to think of those moments, those speed bumps in pre-tax income, as almost downshifting and moving on to something else. And of course, the stuff that they've done with, first of all, in the gaming area with their Xbox and that kind of stuff, then coming to the cloud and basically just reinventing the company. And
well, I want to tell you, Mark, that I see 4, not 3. I'm wondering if we shouldn't have 2 colors in that blue box. And I see a definite split before 2008 backwards, Yeah, right there, before 2008, going backwards, and then 2008 maybe to 2013, maybe even to, well, yeah, definitely to maybe even to 2016, where the growth slowed significantly. The sales growth slowed significantly from where it was in the first half of this century. So if I were putting colors behind this, I might even put 4 colors back there, or break it into 4 parts. But it's the same idea that this is not the same company, and for periods of 3, 4, 5, 10 years, the company has changed itself and managed to reinvent what was going on, and then take off again and stay profitable during the whole mess. That was kind of bumpy profit margins during that 2008 to 2016 time period as well.
Yeah, and I guess that's what I'm getting at also. I think when you get these moments, whether it's macro being driven by something going on in the larger world of the economy, or if they're actually going through a moment where they're basically restructuring and pursuing a different realm of business or that sort of thing. And you're right, Ken. There's a couple moments in there you can argue for something with right there in the middle of the chart also, a period where the sales actually went down year over year for 2 times in their history. But I think what it actually nudges for me is this notion of, if you are dealing with a very high quality company that has been an absolute rule maker in the world of business, and you run into one of these moments, you can either regard it as potentially catastrophic, contraction of profitability, or is it a moment where they're downshifting? And depending on how much faith you have in the quality of management and the field of opportunity, I think you can make a case for if they do restore. And you've heard Hugh McManus talk about this a number of times. This company's not going to disappear from the planet when they come out the other side. This is what they're going to look like. I think that's a consideration. And obviously, if they don't come out of it, they usually either flatline or worse on the other side.
Well, and Mark, we could point to other large dominant companies that have not been able to reinvent themselves fast enough to make the transition. I hate to pick on GE, but we can point right at GE that had the same kind of dominance for decades, but suddenly kind of lost their mojo and kind of forgot who they were and where they were going, and didn't have the leadership to pull them through to the next stage. I'm still not certain that they have the leadership to pull them through to the next stage. I know that their stock has not bubbled around the way they expected it to after they pulled this head fake with the reverse split and everything. I think management is extremely important, and I'm not sure whether there's a Satya Nadella sitting somewhere ready to come to GE's rescue right now.
Yeah, and of course they're out with this strategy to split up into 3 pieces. And what that basically, if I boil it down into very earth speak here, they're basically just telling the investing world, you don't know how to add up the value of my company. What's wrong with you idiots? That's basically what they're saying, and that can be a very tough sell. We'll see. I still think the 3 pieces that will be GE have considerable merit, but they're tarnished. There's no doubt about it. Every time I go to try to enter it when I'm on one of my brokerage screens, it won't let me type in GE, the 2 letters consecutively. So I guess I'm stuck. Anyhow, here's a look at the price and the PE ratios. I found it fascinating. I had forgotten that the PE for Microsoft actually dipped into single digits back in the lost decade. And other than that, though, it looks pretty impressive. That earnings trend is obviously back on a desirable trajectory.
Way back in my investing history, Mark, when I first became fascinated with value line. And when I would carry that notebook around with me, and every spare moment I had, I would try to learn something about what was going on with these mysterious sheets. I was certain that if I could understand every single number on the value line sheet, where they came from, I was certain I was going to be able to make gazillions of dollars in a very short amount of time. And one of the rules that I came up with real quickly in the beginning was, you're not going to find a number one safety stock that has a number one timeliness. There's just never going to be that combination occurring in the value line universe. Well, here's the counterexample to prove me wrong, sitting right here. They like it for the short term, and they think it's about as safe as you can get. So that's something that I never expected to see, especially with a stock that I owned.
I guess I would argue with Value Line that they probably have had quite a run. By the way, Ken, here's one of your phases right here, and it might actually be kind of a backdoor answer to the Value Line and how it changes slope. I wonder how that compares to that picture. You follow me?
I follow you exactly. Yeah.
You know, and then here's a situation where the current price, I believe, is closer to 340 now, or something like that. We'll see in a second here. They're actually quite well above the value line. Now, what is it? It's 335. So at 335, we get a par of five-ish, approximately 5%. Projected return on value of 6 to 7%, and pretty healthy looking picture from top to bottom. Using a PE of 25, projected net margin of 34.5 gets you this. And you can see the growth rate. That's straight off the trend. That is this growth rate on the right-hand side, that trend, which appears to be in pretty good shape. What little debt that they have, what little money they've borrowed is pretty good, but it has been fairly hot. That shows up here, Value Line will probably be upping their estimates on this company, and Morningstar actually sees it as pretty fairly valued.
Yeah, looking backwards, Mark, at that price chart from the Value Line sheet itself, you can see why people got frustrated with this company back in 2008, 9, 10, 11, 12. You can see those steps rather than a nice smooth curve in the price line. You can see, just like we've talked about Home Depot at various times, that they would basically stay flat price-wise for a long period of time, and then it's a jump, and then a flat period again, and then a jump and a flat period again. That's as close to a step graph versus the nice linear graph in 2017 through maybe 18, 19 even, that you can see where the price just kept moving nice smoothly in a generally upward direction. So there's been a lot of things that you had to have patience for and discipline for if you were going to be a long-time owner of Microsoft, and that included understanding where they were headed next in their business model.
Yeah, and again, for the people who are frustrated by being stuck in the mud or on that plateau, when this is going on at the same time, I don't have any trouble finding the patience to deal with that. If the stock price is flat and stagnant, but that's happening on the earnings line, I can generate patience pretty easily with that picture. It's basically it has a better stock selection guide with every passing quarter.
So you never sat in a stock club meeting, Mark, where you heard somebody say, Microsoft's price hasn't changed in 12 months, let's sell it?
Oh, I've sat in those meetings.
You sat in those meetings. Okay, that's what I'm referring to, where it takes a sledgehammer sometimes to wrap the knuckles and to say, what are you talking about? And go from there.
Well, anyhow, I agree. I've been in that moment. I think these longer term perspectives, I hope the audience enjoys them. I think we're going to have some fun with them. And I think the lessons have the potential to just pour out of them. Good stuff. All right. So there's your look at Microsoft for now. And it is our largest holding in the roundtable tracking portfolio. So with that, we'll leave with a Christmas image from Laura Scott down in Florida. I think she might be a member of that model club that just took over the lead. Need to check in with her on that. but Laura actually posted this Floridian sunset here in the last few days. I thought it was pretty cool. All right, Ken, anything else you'd like to add?
Great print for a Hawaiian shirt, Mark, with the trees and things in black and the colors in the sky. Great print. Yeah.
I'm on it. Maybe I can get Ollie to work on that for me.
All right.
All right. Any closing thoughts, Ken?
No, I have Christmas presents to wrap, and I finished my shopping yesterday, though. However, so now we're on the downhill slide. So I'm feeling really good about everything. I might even have an eggnog tonight. We'll have to see.
We are close with our meandering and a few keyboard moments. We're close to finishing up, and that's
all right.
You know, I don't usually start until about the 23rd, so
I do feel jealous, Mark, that you have lots of little kids to buy for. That is the most fun shopping of anything.
Well,
I'll tell you, the grandkids that are in their late teens and early 20s give you kind of boring lists, you know.
Well, Ken, as you well know, Wendy and I are willing to be small children anytime you need somebody to buy for. All right. Enough frivolity. It hasn't worked in the past. It won't work now. Although you did give me a really cool rhino ornament a few years ago.
Yeah, I did.
Yeah, thank you for that.
Matt Spielman's going to leave us with a thought for the day, Mark.
Okay.
Price is what you pay. Value is what you get, from Mr. Buffett. Absolutely. So I think that's a great quote for us to end on. Okay.
All right. Thanks, everybody. See you next time. Thanks, Ken.
Thank you, Mark. Goodbye, everybody.